In Chapter 4, we talk about merchandise inventory and companies that buy and sell merchandise. So in these journal entry examples, we're first going to look at the company that is selling inventory, and then second, we're going to look at those same transactions for the company that is buying the inventory. So you can see the difference between selling and buying inventory. We're going to look at these 5 transactions for each company. So on May 3rd, we're Allied for the first day. On May 3rd, it says that we made our first and only purchase of inventory for the period. We purchased 2,000 units at a price of $10 cash per unit. We gain merchandise inventory, which is a current asset. We take 2,000 times 10, and we debit cash because it says that we credit cash because it says that we paid cash. Now you can see that we have the gross method and the net method here. We're going to go all the way through the gross method, and then we'll talk about the few differences in the net method. May 5th, Allied sold 1,500 of the units in inventory for $14 per unit to Macy Company under credit terms 2, 10, and 60. So those credit terms say that if they pay within 10 days, we give them a 2% discount. Otherwise, their entire balance is due in 60 days. That's what the N60 is, net 60. So when we sell merchandise, we need to record 2 transactions. The first one is to record the sale and the sales revenue, and the second one is to record the cost of inventory. So first we'll record the sale. We sold it to them on credit, so now we have an accounts receivable. And that amount is 1,500 units times $14 per unit. We record our sales revenue of 21,000. The second part of that journal entry is for the inventory. So we record inventory when we sell it into an expense account called cost of goods sold. So cost of goods sold and that is for the cost of the inventory. So remember that inventory cost us $10 per unit. So those 1,500 units were $10 per unit. Then the difference between sales revenue and cost of goods sold is the profit we earned on that inventory. The credit is to remove the merchandise inventory from our books that we just sold. On May 7th, the company returns 125 units because they did not fit the customer's needs. We're able to put these units back into its inventory. So they returned some of the inventory. We need to reduce their account receivable, and we need to restore 125 units into our inventory. So first we're going to reduce the accounts receivable. Sales revenue has a contra asset called sales returns and allowances. Then we reduce their accounts receivable for the same amount for those 125 units. Now we need to restore our inventory for the cost of inventory and reduce our cost of goods sold. On May 8th, they discover that 200 units are damaged but are still of use, so they decide to keep the units. They've asked us to credit their account for the defective products, so we agree to give them a credit for $300 to compensate for that damage. So that would be a sales allowance. which also goes in that sales returns and allowances. And we would reduce their accounts receivable by $300. Now it's May 15th, and we received payment from Macy for the amount owed on the May 5th purchase. This is 10 days after the purchase, so they've paid within time to get that 2% discount. May 15th, we're going to receive cash. We're going to credit their accounts receivable. And then we also have a debit to an account called sales discounts. Sales discounts is a contra sales account, just like sales returns and allowances. So what is the amount that Macy has left in their accounts receivable? We started with $21,000. We subtracted $17,000 and then subtracted $300. So what we have left at the end of the month is $18,950. On that, they paid within 10 days, so they get a 2% discount. So if we take this times 98%, because that removes that 2% discount, oh, that's the cash amount. .02 for the discount amount. And so that is the recording of journal entries for the seller. If we were doing this the net method, what the net method does instead of the gross method is that it records items net of discount. That means instead of waiting until they pay to record the discount, we record the discount on the time we record their purchase. So there is no change to the first journal entry. But this journal entry that happens on May 5th would be recorded at 21,000 times 98%, because the net method assumes that they're going to take that discount available to them. So we would record that amount net of discount. Now we also need to deal with that discount every time that we have a journal entry. So then on this one, we would also have a discount. This would be $1,750 times 98%. Okay. The cost of the merchandise stays the same. What sales discounts do is reduce the amount of profit that we receive, but we're willing to reduce that 2% profit in order to receive cash earlier. Then the last payment, this would be the same. And that last payment, we would just receive cash for the amount that was in their accounts receivable, because we already recorded the discount earlier. Okay. Now let's look at those journal entries from the aspect of the buyer. So now we're going to look at the same transaction as the buyer. On May 3rd, Allied Company bought merchandise. There is no journal entry for this on the side of the buyer. On May 5th, we purchased inventory from Allied Company. So if you remember, the sale to record the sale of inventory has those two parts, the sales revenue and the inventory. But if we're purchasing inventory, we just receive the inventory. So we receive merchandise inventory of 21,000. And now we have an accounts payable to Allied. On May 7th, we return 125 units. So we have less accounts payable and we have less merchandise. On May 8th, we discover that 200 units are scuffed, but we decide to keep them for an account credit. If you remember, Allied had to record that as a sales return and allowance. We are just going to reduce our accounts payable and our merchandise inventory. Then on May 15th, we pay for the sale. We reduce our accounts payable instead of a sales discount account, we put it in our merchandise inventory account. We reduce our merchandise inventory by the amount of the discount. So our accounts payable is $18,950. We reduce our inventory by that discount of $379, and then we pay $18,571 in cash. Okay. For the net method, we see the same exact things as we did on the other one. For the net method, when we received that inventory, we would record it net of the discount. So with the belief that we were going to take that discount. The last thing that we discuss in Chapter 4 is a multi-step income statement. So in Chapters 1 through 3, our income statement is sales revenues minus expenses equals net income. We expand on that equation in Chapter 4 for our merchandise inventory. Now we have sales minus cost of goods sold equals gross profit, and gross profit minus expenses equals net income. So we're going to build a multi-step income statement. We always start with sales. So regardless of what format you're using, it always starts with sales. So we have $225,600 in sales. Then we have those two contra accounts, sales discounts and sales returns and allowances. So we have discounts, $2,250 and $12,000 in sales returns. We add those together and we subtract that from sales to get the net sales amount. So sales minus sales discounts and sales returns. And now, then we put cost of goods sold. So cost of goods sold, $74,500. The difference between cost of goods sold and our net sales is our gross profit. Then we list our expenses. We have two categories of expenses. We have selling expenses and we have office or general and administrative expenses. So we have sales salaries, rent expense, selling space, our store supplies, and our advertising expense. These are our four selling expenses. So our total selling expenses equal the total of those expenses. Then we have our general and administrative expenses. These are remaining expenses, the office salaries, the office space, and office supplies. Add those together to get our total general and administrative expenses. Gross profit minus total expenses equals our net income. And that is a multi-step income statement.